Welcome to this video tutorial on the FinanceStarter T12M online corporate finance program. I'm Chris Wutsky with Parametric Finance, and I'm about to show you the powerful features of the FinanceStarter T12M in assessing the financeability of a major business initiative, such as a business acquisition, major asset purchase, or a shareholder buyout. The T12M moniker denotes that this program, like the Finance Tester, requires only your most recent annual financial statements. This tutorial builds on the video tutorial for the Finance Tester, where we entered the financial information in the input panel and then adjusted certain balance sheet items and growth rate assumptions. In this tutorial, we'll explore the Financing Parameters panel and the Financing Override panel. Recall that the primary purpose of the Finance Tester was to test the financeability of your business objective, with sufficient financing capacity indicating a go, and insufficient financing capacity indicating a need to re-examine the business plan. The FinanceStarter takes this assessment process further to facilitate an actual financing transaction. With reference to our video tutorials providing overviews of specific financing transactions, there are essentially 4 phases to conducting a financing transaction: testing, refining, pitching, and funding. Testing can be accomplished by the Finance Tester alone, but it's limited by its lack of access to the financing parameters and ability to specify the financing amounts. The FinanceStarter provides access to this functionality, so let's have a closer look at the elements. The quick guide to the Finance Tester T12M provides detailed information on how to get the most out of the Finance Tester. The capital market is very complex, so it helps to categorize the types of instruments. We see 3 main buckets: senior secured debt financing, where there is a first charge on the assets being financed; cash flow or subordinated debt financing, which has a subordinated security position or no security at all; and finally equity, which is typically preferred or common shares without terms for repayment. Each of these is provided upon terms that constitute constraints on the financing capacity of the business. These terms can also be seen as 3 buckets: collateral loan value, financial covenants, and cost of capital. Looking down the Financing Parameters panel, you will first see the senior secured debt financing. That's over here. Revolving credit lines, capital leases, term debt on equipment or non-real estate, senior term debt on real estate, cash flow lending, equity. For each of these, there will be a combination of limiters and cost of capital. For debt facilities, the limiters are typically a percentage of the collateral, whereas for cash flow or subordinated debt facilities, they are limited to some sort of cash flow-based multiple. Cost of capital is represented by the repayment obligations computed based on the interest rate, term, and repayment method, such as principal plus interest, blended, or interest only. The entire capital structure is constrained by financial covenants that lenders typically impose. We have boiled them down to 3 key ones that, if you can satisfy these, there's a good chance that you'll be able to satisfy any that the lender may choose to apply. So now let's have a look at some of the financing parameters and how they affect the financing. There is a completed Finance Tester sample on the website that you can access and play with yourself. Okay, so returning to the FinanceStarter input panel here, specifically the financing parameters, again, just need to pay attention to the green cells. Those are the variable cells that can be adjusted. They will reflect amounts that are consistent with typical conservative financing parameters. They may not necessarily reflect a limiter, but will reflect an effective percentage. So an example of that might be the loan to value or the advance rate on accounts receivable. Often you'll see a 75% or higher advance rate on receivables, but the effective advance rate on the receivables reported in the financial statements is oftentimes much less due to rights of offset, priority claims, and a number of other things that are described in the guide to the Finance tester. But we can go down, we can adjust these things, we can adjust the interest rate. Again, where starting points are reasonably conservative, but they can be adjusted. One of the key things here is the capital leases. We don't model capital leases, but quite often customers seeking financing will already have some capital leases. This is a good place to enter in the term for the finance leases if they're different than the 4 years here. 4 years, we see all sorts of stuff, 3 to 5 years. We've got 5 years or 4 years reflected here. Similarly on equipment, the advance rates on equipment can vary widely. It can vary from 30% to 80% or even 100%. So we've started somewhere in between, and you can adjust these to see how it'll affect your business. And we can try that now by just changing this 50% to 70%. Okay. And we can see that nothing has changed. Why would that be? That's because, as we can see below, a constraint has been reached, and that's been the working capital ratio at 1.35. If we adjust this ratio downward to relax that constraint, we'll be able to access more of the equipment collateral value. Again, I won't belabor it here, but you can go down every one of these and consider whether a refinement needs to be made here in terms of years. For example, if the equipment as a class, as a general group, typically has a longer life than 4 years or 48 months, it might make sense to extend that term, because that term extension will then allow a higher finance capacity. Again, you can see that it has not made much of a difference because our working capital constraint has pinched off access to more financing. So there again, we're going to come to that in a minute down below. So we'll return it back to its default. Similar concept applies all the way down. We have the choice to adjust principal plus interest to blended. Typically, the blended will adversely affect covenants in the early years and therefore reduce financing capacity, but a principal plus interest will increase shareholder value of the longer term because the interest costs are lower. Moving down to real estate, again, you'll see that the loan value typically is higher, the term is longer, and the interest rate is lower, and that's as compared to equipment financing. The real estate just is a lower risk asset class that lenders have more advantageous financing terms on. Cash flow, this is a special category that I would not recommend be changed, because there's very unique instruments here ranging from senior secured cash flow loans all the way to mezzanine finance. The terms and the interest rates reflect generally the security position. So on a senior secured cash flow loan, typically you'll find the rates are lower, and there'll be a repayment term associated with, whereas for a mezzanine finance, the rates will be lower and they might be an interest only, so a balloon payment at the end. Again, these can vary widely, and you can play with them right here, and we should do that right now. If we change the principal plus interest to interest only, you can see that adds $1 million to the finance. So not a lot. Again, the working capital limiter has constrained our abilities here, and we're going to come to that in a minute. So equity, again, we've used a limiter of 5 times. If you have an asset-intensive business, you may want to increase this to reflect the fact that enterprise value to EBITDA multiples or valuation multiples for asset-intensive businesses can be higher, but we've limited this to the higher end of a typical range that would apply to small and medium-sized businesses. So that brings us down to the financial covenants, or the key financial ratios, and we've been talking a lot about the working capital ratio. The limiter will depend really on the business. In this case, we see that the working capital ratio was the breach, and the fixed charge coverage ratio at 1.32 came awfully close. It didn't breach it, but it came close. So if we go up here and we change this working capital ratio to 1.2, say, okay, you can see that it becomes a limiter, but the financing capacity has increased. Okay, so we're going to put that back because I want to be able to see the changes. If we apply something like an asset-based lender to it, you'll see we can add a couple $1 million to the financing, to the funded value of the business. Okay, so these things do make a difference. We're starting with typical conventional ones, and you can play with each one in turn to see how the financing strategy is affected. And again, this will differ for each business. Okay? Quite often, it won't be necessary to adjust the financing parameters. Where the adjustment of those parameters comes in really handy is where you're evaluating term sheets in the funding phase of the financing. But in the refinement phase, it really won't be necessary so much unless you anticipate a significantly different type of financing terms, such as an asset-based lender or a mezzanine debt provider that has no payment returns, these sorts of things. But at this point, you may not need to change it. Where this finance starter becomes very useful, though, is where you're wanting to actually prepare for a financing, and you do not. Obviously, you're not going to be going to the market for exactly the maximum amounts you've modeled here. Typically, it'd be some lower amount. So a good example of that would be where you are, say, going to acquire a business, and let's say it's this particular business, and you're trying to fund the acquisition of the business. Well, we've seen here that a maximum financing for that business might be $49 million, which together with surplus cash is a purchase price of $61 million. Okay, so let's say you want to acquire this business. Typically, you're not going to make an offer for $61 million. You'll make some other lower offer that you think the vendor will accept. And then, so of course, if you're in the negotiation phase, you'll want to test that offer along the way. So let's say, for sake of example, that we want to offer $50 million for this business, and we want to explore the financing strategies that add up, that will facilitate the purchase of this business at $50 million. Well, the way to do that is, let's just capture these numbers. This will be a little more tedious on the website. I'm using the model directly. First, capture the numbers here. We'll switch over to the override, so the model will be these numbers will drive the analysis, and then we proceed to change the numbers. So one of the easiest things to do is to remove high cost financing facilities, or those that likely have imposed a problem on the constraints here. So operating loan would be one, and the cash flow would be the other. So let's delete that, and you can see just by deleting those, we've already improved things. Okay, the working capital ratio is solid; it's not red anymore, and the working capital is kind of shown as red, but it's well above your limiter of 1.35. So just by removing those two financing facilities, you can see things have improved. Now we're showing a purchase price of $53 million here. We're thinking about offering 50. So the question then becomes is, where do you want to adjust? Typically that'll be the equity, because the numbers shown here are the maximum amount of equity that you could raise for the financing. And typically you don't want to be diluted to that extent. You want to have, the acquirer will likely want to have some economic interest in the acquisition. So if you raise as much equity as this model will indicate, you'll be basically diluted out of that position. So what we can do is we just basically adjust this down by around $3.5 million. So that's what, 25.5 brings us into the neighborhood of a $50 million purchase price, and we can see that our financing strategy is greatly simplified. It's a lot easier to go to the market for two types of financing rather than four, and we can see here that our financial covenants are good. We have an adequate IRR in the equity here. These figures are explained in the guide, but basically this is the equity percentage that needs to be given up to provide the market rate of return to the equity holders. That would be an 80% dilution and an IRR for 100%. If they were to full dilution, would be 35%. So the objective with these numbers is to see if you can bring the equity financing down, or have the equity person accept a lower implicit rate of return, which can be driven by the growth rates in part. But if we just change the required rate of return on equity from 30% to 25%, say, which is within the realm of a buyout, you can see that the dilution has decreased by almost 15%. So fairly significant, these sorts of things. And that can be examined while you're in the process of trying to refine your financing strategy for the purpose of going to the market. When you've got a deal that you want to pursue that's reflected in the Finance Starter here, you'll want to obviously go to the marketplace, go to specific sources of financing and present the financing opportunity, because you want to put financing facilities in place. Well, the report that can be ordered that reflects these particular inputs can be very useful in preparing the documents to do that. Simply order the report from us. You can copy-paste tables and analyses right into a confidential information memorandum template, which you can also find on the website. This will make your life a lot easier, make your materials appear to be much more sophisticated to the lender, and should have a higher probability of getting their attention and ultimately being successful in the financing. After you've gotten the term sheets in from the lenders who are interested in providing, in this case, senior term financing, both on the real estate and the equipment, and also the proposals from equity firms, what you'll want to do is you'll want to put the proposed terms back into the Finance Starter and make sure that everything is working out all right. So what you would do is you'd put in the actual quoted interest rates along here. You would check the amortization period. So if, for example, your real estate has now a 20-year amortization, that will improve things, and you will be able to just double check those things. Chances are, if you've left enough room in your financial ratios and your advance rates here, you shouldn't be offside, but you'll just want to double check that. So as you can see, the Finance Tester T12M makes quick work of the financial analysis to identify achievable strategies and then obtain the accompanying financing strategies report that will confirm the assumptions, provide the detailed analysis, as well as potentially interested funders. Thank you for watching. We invite you to review our other guides and video tutorials, and we look forward to assisting you in your next successful financing.